Hi, good morning. Welcome to the Market Wrap number 128. Stuart Williamson here at the helm. As you can see, a bit of a different location, um, but I want to keep the continuity going. So every week, dropping a market wrap in. So we're just letting people know what we think is going on in the marketplace, and trying to help you make buying decisions. This week we just come up from Singapore. We did a great, I call it a client networking event, as you can see from the video. Very good, very well attended. We have speakers from Sandstone Property who do BRRR, as we call it, buy, renovate, remortgage, rent out. The idea is you buy at a cheaper price, make your money on the way in, as builders like to say, and then remortgage. Rental rates are very good on this sort of thing. You're looking at 6% plus, up to Dundee. We do some stuff at maybe 10%. Then we had API, who are a UK property sales company. They have new developments all over the north, Manchester, Birmingham, down to London. They talked about what they thought was going on in the UK market. Again, very interesting. Finally, Godwin Developments, who basically do 2-year fixed deposits. They're a big development company. At the moment, they've got a contract to do a lot of the electrical charging points on the motorways in the UK. And what they do is they basically borrow £5,000 or more and will give you 10% plus per year back over 2 years. Very finally, Scott Mitchell, the mortgage man, a great talker. He came up with an amazing fact, which was that it's currently cheaper to get a 5-year fix at 4.75% when based in Singapore than it is in the UK, which is amazing, really. So great mortgages out there still to be had. We'll probably reach the peak, hopefully, with the pension companies have stopped panicking, mortgage rates are coming down, so happy days. Now this week we're going to talk just about the recession, what sort of recession we're going to have. Is the UK economy in general in for a massive crash? I mean, basically, I'll put my glasses on. I'm going a bit old school because we're having written on paper this week. Get ready for the weirdest recession in history. Okay, the Bank of England says we're in a recession, we're going into it, but we're going to call it the non-recessionary recession. What are the indicators of recession? Okay, rising unemployment. We haven't got that. Mounting bad debt experience. Very little of that. Nothing to write home about. Collapsing house prices and ruinous foreclosures. Repossessions. Again, excuse me. That's not currently happening. Okay, you might say yet, and many of our watchers will say yet. It's going to be 40%, 50% falls in value. We are going through a very big squeeze in the UK with energy prices and cost of living. Anything that seems to be going up well is inflation. It's up near 10%. But we're not seeing non-performing loans occurring yet. And those who are at the coalface of credit markets, i.e. those people who are dealing in non-performing loans, they don't believe it's going to happen. There's a guy called Burkhard Hepp, who's the Chief Technology Officer at NPL Markets, which is a platform for trading non-performing loans. He anticipates that non-performing loans are likely to peak as little more than 2% of the total. 2%. And that compares very favourably with the global financial crisis when it was 4%. It may go higher, but they don't believe it will do so. Okay, now what about what recessions are built on? Now most recessions are built on crazy spending in the household and corporate sectors. You look at the last 3 recessions, that's exactly what occurred. This time around, you can hardly say that, the pandemic, the energy crisis has caused overspending. Quite the opposite. There's been more saving and less spending going on. And it is statistically true that there's far less than all 3 previous recessions. In fact, the build-up of debt is in the public sector, which helped prop up households and businesses during lockdown. Now it's during the financial crisis, during the energy crisis, and basically the government's running its own finances into the ground. So it's a sense really that the state and not the individuals or the private sector are really in the doo-doo. And it is, well, that's certainly our view. There are some worrying signs in the housing market. Okay, viewings and estate agent football have gone through the floor. Footfall, that is not football. New mortgage approvals have dropped sharply. But there's little reason, we don't believe, to see an outright crash. Because we've long gone are the sort of heady days of 105% deposits, self-certification, all that sort of stuff. Now it's a lot more controlled, and the average mortgage in the UK is 60% of loan to value. So if you're going to get a fall, it's going to be a big fall in house prices before we get to that general negative equity area. Mortgage lenders very, very unhappy about going down the foreclosure, the repossession route. It's going to take 2 years to do that, by which time we could be out of this recession. So why would they want to do it? Also politically very inept of them to start doing that. And finally, 1% of customers currently are in financial difficulties, according to Charlie Nunn, who's the chief exec of Lloyds Banking Group. It is a difficult time for consumers and businesses, but not an extreme recession, he quotes. So we believe we're looking at a long but shallow recession. It's not going to be it's not going to be a collapse. It's going to be a hiatus of growth, and it's what's needed in the UK property market. There's been too much irrational exuberance, as Alan Greenspan would say. So it'd be good for it to calm down. I think it'd be helpful also if the government was to start to appreciate that it is more of a governmental issue, and stop all this histrionics about there's a crisis at hand, because it's as you say, it's frightening the children, and it is. Because a lot of people do say, what's going on? It's all end is nigh. And all they've read is the clickbait press that is just trying to sell stuff. And it's wrong, really. So that's our view. We don't believe it's going to be a crisis. And a lot of our clients don't. We launched a Sheffield Phase 1 development last month. It was sold out within a week. Good rental yield, 6% plus. Sheffield, great location, good development for the future. And it's in line with the concept that Jones Lang LaSalle was talking about last week, have a two-stream market. You've got people coming back in from the country because recession's on the horizon, and the bosses are saying, no more of this working from home. Get yourself into the office. And a lot of people are doing that. And at the same time, they don't want to sell their country homes. So they're renting in city centres, or they're buying in city centres. 1 beds in HMOs, studios, 1 bed flats, 2 bed flats, small stuff is selling like hotcakes, being rented like hotcakes. You can't get it easily in Birmingham, Manchester, Nottingham, those sort of places. Centre of London. I've got a friend whose daughter's trying to get a rental there. Increase their bid 5 times and still do outbid by other people. So it's a different sort of scenario we've got. So that's it for this week. I don't believe there is a recession that's going to kill everything off. It's going to be a long, drawn-out, painful bit, and that's good because prices will catch up. It'll allow inflation to eat away at debt. If you enjoyed that, please do subscribe, do like. And next week we'll be doing it from somewhere a little bit colder. Do take care. Thank you very much for watching. Cheerio.